everybody. It is Thursday, March 17th. Happy St. Patrick's Day. I wanted to jump on here real quick because there's been a lot of information and numbers, data that came out last week and this week. And we're having a lot of conversations and questions around it. So last week, the inflation rate for the month of February came out, and that is at 7.9% over a 12-month period. Now, putting that in perspective, it was 7% in December, 7.5% in January, and now we're at 7.9%. So the inflation rate, the cost of goods, kind of the CPI number, consumer price index, has continued to increase, has continued to go up. Now, this week the Fed met, and we've been talking a lot about it. They have decided to increase interest rates 0.25%. And they're projected to do these rate hikes about six more times. And so we're getting questions on, what does this mean? Why does the Fed do that? And so inflation, what's happening is there's a lot of demand, not enough supply. And we kind of saw that through coronavirus, right? We saw, supply chain bottlenecks. There was, all the stimulus checks, all the funds being pumped into the economy, increasing demand. So when we have an increase in demand, not enough supply, inflation. And so one of the ways the Fed can kind of combat or hedge inflation is through monetary policy. And how they do that is raising the interest rates. So it's going to cost banks more to borrow. It's going to cost more for your mortgage to buy a home, buy a car, thus decreasing, the demand, allowing the supply to kind of catch back up, decreasing inflation. And so that's kind of what we've seen play out. And I'm going to show you how this has happened in the past. And a good example. So in the 1960s and 70s, you had the Vietnam War, you had a ton of spending. Inflation started to increase. You had a lot of people, asking for salary increases from their employers because the overall cost to live for the cost of goods had gotten almost out of control. So you can see here in 1979, inflation was 14.8%. So when you think about that, we're at 7.9%. In 1979, it was 14.8%, almost 15% inflation rate. And so at the time, President Jimmy Carter had nominated Paul Volcker as the chairman of the Federal Reserve. And Paul Volcker came in and said, I'm going to kind of change monetary policy. We're going to increase, the interest rates. And he did it pretty rapidly and strongly. And what you can see here, when he did that in 1979, by about 1983, interest rates were below 3%. And so that's kind of how you can see how the decisions the Fed makes can impact the economy and can help, hedge against inflation a bit. So if you have questions, concerns, what are things investors can do in terms of, the inflation rate and things with your investments, please reach out to us at Bolt Financial Group.